All right, welcome to This Explainer. Today, we're going to dive right into how a major shipping company took absolute global geopolitical chaos and somehow turned it into record-breaking profits. We are unpacking the fiscal year 2026 results for Dorian LPG. They're a leading owner and operator of very large gas carriers, or VLGCs, which basically means they specialize in moving massive amounts of liquefied petroleum gas all over the world. And as you probably know, over the last year, the map of global trade was completely turned upside down. So we're going to look at exactly how Dorian navigated this massive structural shift and turned it into some truly extraordinary financial gains. Now, to get a sense of the scale here, just look at this massive cumulative dividend payout. Dorian has paid out nearly $770 million to its shareholders since June 2021. To really put that into perspective, they generated $835 million in net income over that exact same time frame, meaning they are returning the vast majority of their earnings right back to investors. It's huge, but it totally begs the question, how on earth did a de facto blockade over in the Middle East create such a massive payday for a shipping company based in Connecticut? Well, let's get into part one, geopolitics and shipping bottlenecks. So, picture this. Early 2026, we see the stark reality of the de facto closure of the Strait of Hormuz. Because of escalating conflicts and major infrastructure disruptions, Middle Eastern supply was choked off almost overnight. I mean, we're talking about a drop from 4 million metric tons of LPG exports in February 2026, plummeting down to just 1.3 million by March. Suddenly, major importing nations in Asia were facing an absolute supply crisis. Take India, for example. Their monthly LPG imports fell off a cliff, going from 2.2 million metric tons in January to under 500,000 by March. Naturally, Asian importers absolutely panicked. They had to rewrite their procurement strategies on the fly. And where did they turn? North America. U.S. LPG exports surged from 5.5 million metric tons in February to nearly 6.3 million metric tons in just 1 month. Now, why does this matter for Dorian LPG? Well, about 90% of their exposure was in U.S. and Canadian liftings. So when the market completely shifted its reliance to cargoes moving from the U.S. all the way to Asia, trade lanes got a lot longer, the demand for ships skyrocketed, and Dorian was sitting right there, perfectly positioned to capitalize on the whole shebang. That brings us to Section 2, Record Freight Rates Achieved. Okay, real quick, before we talk numbers, we need to define a critical metric. It's called TCE, or Time Charter Equivalent. Think of this as the ultimate benchmark for measuring the daily earning power of these massive, state-of-the-art ships. You just take your voyage revenues, subtract your voyage expenses like bunker fuel and port canal charges, and divide that by the available days. And here is where things get really wild. By taking full advantage of that incredibly lucrative US to Asia route and running their spot trading program through the Helios pool, Dorian pushed their Q4 TCE to over $63,000 a day. That's right, more than 63 grand a day. That is the second highest rate in the entire history of the company. When your ships are pulling in that kind of cash every single day they're available, it sets the stage for a seriously spectacular earnings report. So let's look at that report in Section 3, the FY 2026 Financial Results Breakdown. We are talking about a staggering 10 times jump in Q4 net income year over year. It literally exploded from $8.1 million in the fourth quarter of 2025 to exactly $81 million in Q4 of 2026. This is practically a masterclass in the immense operating leverage of the shipping industry. Because think about it. Once your fixed costs, crew, basic daily operating expenses, which were holding steady at around $9,500 a day, once those are covered, almost all of that extra TCE revenue from the surging spot market falls directly to the bottom line. But zooming out and looking at the entire fiscal year, we see this wasn't just some brief one-quarter fluke. Revenues surged over 36% to hit almost $500 million, $481.5 million to be exact. Net income for the year reached $193.7 million. And their adjusted EBITDA? A massive $305.1 million. This was a sustained period of highly profitable execution, all driven by strong market fundamentals, lower bunker prices, and their fleet's ability to capture that wide geographic arbitrage. Which naturally leads us to Section 4, the dividend and capital strategy. Despite all these incredible, record-breaking earnings, Dorian maintained a surprisingly conservative balance sheet. They ended the fiscal year with $327.4 million in free cash, against $565.8 million in outstanding long-term debt. And actually, after accounting for a few imminent fleet transactions, their net indebtedness drops to less than $200 million. They're making sure to keep plenty of dry powder on hand. And this tension right here is exactly what their chief financial officer, Theodore Young, meant when he said capital allocation is a dynamic balancing act. They are constantly weighing the desire to hand out massive payouts to shareholders against the reality that, well, ships get older, technology changes, and you still have to service that debt. The shipping sector can be incredibly volatile, so preserving that financial flexibility to reinvest in the fleet is absolutely paramount. But for Q4, that balancing act resulted in a $1 per share irregular dividend. This was actually their 19th irregular dividend. And as management pointed out, it shows immense confidence in the long-term sustainability of LPG demand and their own near-term cash generation. They are making absolutely sure that investors share directly in the spoils of this geopolitical shift. Finally, let's look at the horizon in Section 5, Fleet Moves and Future Regulations. To stay on top, they've been actively upgrading their fleet. First up, they took delivery of the Orion, which is this highly efficient dual-fuel vessel capable of running on LPG, cutting carbon emissions by about 20%. Second, they opportunistically sold a 2015-built ship named Cobra for a massive $30 million gain. Guys, they literally sold it for more than they originally paid to build it. That is incredible. And third, they repurchased the Corsair from a sale-leaseback arrangement, which is a really smart move to lower their overall cash break-even rate. But hey, it's not all smooth sailing, pun intended. This huge shift to U.S. exports means they rely heavily on the Panama Canal. And recently, auction fees just to secure transit have spiked from $200,000 to a mind-blowing $4 million. That takes a huge bite right out of those headline TCE rates we talked about. On top of that, their older 2014 to 2016 class ships are going to need dry docking and capital upgrades pretty soon. And looming over the entire industry is the International Maritime Organization's Net Zero Framework, bringing in strict environmental regulations starting in 2028. So, as we wrap up this explainer, the crucial takeaway is this. Dorian LPG played the geopolitical hand they were dealt in 2026 perfectly. It resulted in immense profitability and returned a mountain of capital to their shareholders. But as global supply chains continuously rewrite themselves, and as these new environmental regulations force incredibly costly fleet upgrades, we have to ask, can Dorian's brilliant balancing act of capital allocation actually survive when the next major macroeconomic shock hits? It is a truly fascinating space to watch, and I hope this breakdown helped you see exactly how all these moving parts connect. Thanks for joining me on this explainer, and keep learning.